Hey, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. I'm going to answer the question today on what is the catch, what's the drawbacks for a lifetime income annuity. We're talking about guaranteed income for life. And yes, there's always a catch, right? People say, well, this is too good to be true. I just had a guy tell me yesterday, this looks way too good to be true. I should buy one for myself. He was getting one for his brother, and he's thinking I'd like to get one for, it's like, wow, like this is such a good payout. I'm like, well, it's just numbers. It's just math, okay? And insurance companies, they know exactly how long you're going to live, and they know exactly what the payout's going to be. But at the same time, we also want the guaranteed pension, and we could take it for as long as 30 or 40 years. So depending on how long we live. So it's really nice to be able to have that peace of mind. But there's always a catch. So let's talk about the catch, okay? So I'm going to share my screen and I'm going to show you what these are paying out, and I'm going to show you the catch. I'm going to show you the drawbacks. I'm going to show you, hey, what am I missing here? People are always like, well, what am I missing here? What questions am I not asking? Okay, well, let's talk about that. Okay. All right. So I threw in someone from Colorado. They're 62 years old. They got $500,000 and they want to take income in 5 years. Okay. In 5 years, it's $57,000 a year with EquiTrust, F&G, ClearSpring, and so on. There's a lot of different carriers here. And again, if you're looking for an annuity contract, book a call with me. There's a link below this video, and I can help you with that. Otherwise, you can go to my website, johnstevenson.com, and you'll be able to search annuities for yourself. And then if you feel comfortable, you can book a call with me there. So let's take a look at if he was to wait, he might be thinking, you know what? I don't want to wait 5 years. I'm okay with less income. I know it's not going to grow as long, but I want some income in 12 months from now. Okay. Well, the same 500 grand will give him almost $42,000 a year, guaranteed income. You're like, all right, that's really good. What is the catch? What is the catch, John? Okay. Well, let's look at the catch. Okay. So for this top one, it's National Western Life. Good company, A-. I've worked with them a lot. Okay. So we'll go in here and we'll illustrate it, and let's talk about the catch. Let's talk about what is the problem with this particular contract. Okay. Well, let's talk about the problems. Guaranteed values right here. You'll notice the income is guaranteed. You got $42,000 a year guaranteed for the rest of your life, which is fine. But the problems is what if the index that it's tied to, which is the S&P 500, what if it experiences a recession, okay? What if there's no growth? You can see right here, what if there's no growth? Well, your account balance is going to run out. It's going to run out really fast, like by the time you're 74, okay? If you're taking income, it doesn't matter, but some people care about that, okay? Also, the catch over here is there's a rider charge. Look at that. Look at that cost right there. Oh my goodness. You look at that. It's like $100 grand. It's like $100 grand in fees. You're like, oh, that's a catch, John. Mm-hmm. Yeah, it is. And I'll show you. Like if I say, well, let's just get rid of that catch. No rider fee. Don't want to pay any fees. Great. No problem. All right. So basically the difference is you get $30,000 a year guaranteed income. Your account balance lasts longer and there's no fees. So you look at that and say, well, but I'm going to take this income for like 35 years. All right. Well, 35 times 11, it's like $385,000 in more income I could have had if I just had paid $100,000 in fees. That's like $285,000 in extra income, net income after the fees. Okay. Well, I mean, there is a catch, right? You got the fee, but you get an extra 285 grand in net income. So you tell me, is that a drawback? I mean, it could be for sure. I mean, if you want your account balance to last, absolutely, that could be a problem. I mean, you can see here, this one that pays 30 grand a year, it's guaranteed. And they show you the account balance lasts until you're like 80 if there's no growth. And then they show you if there is growth, it'll last about the same. So I don't know. I mean, the account balance lasts, they do give you some extras here. So if it does have some growth, this one actually gives you increasing income. So that's kind of cool. Allianz is great for increasing income if you want, especially if you're thinking about, hey, I'd like to have something that gives me increasing income to keep pace with inflation. It's a good option. So, but again, if you're just looking for, most of these contracts, they will not increase. Like, look at this one. This one probably doesn't increase. It's probably just the same here. Let's just look here. Yes, $29,000. It doesn't increase, but look at the account value. They're showing the account value is staying current. So that's one way to get rid of that problem, is to have no fees. But again, this is not guaranteed. This is based off of this growth rate right here, which may or may not happen. So keep that in mind. All right, so let's go back here. And you know what? It doesn't matter to me. Just disclaimer here. I don't care if you get an income rider with a fee or without. Okay, they pay me the same commissions. Okay, the fee here goes to the insurance company. It does not matter to me. But I always do recommend, if people are looking for highest annual income that's contractual and they don't care about leaving this particular account for legacy, then I just tell them, pay the fee. If you want more income, pay the fee. Who cares? The fee comes out of the account balance. It doesn't come out of your income. Okay, the income's net. So anyways, but that's totally up to you. And I'll show you everything. So, all right, so let's go back here. Let's talk about some more problems, okay? So I'm just go right back here. I want to look at these. You know what? Let's go further here. Let me pull this here out to 5 years, and then I'm going to put a spouse on. I don't even talk about that. Okay, this is a single payout. Now with a spouse, they're on the hook for 2 lives now, right? It's going to be less. So let's say the spouses are the same age, just to keep things simple. Well, it's $52,000 a year. Okay, it's definitely less than the 57, but at least it's guaranteed for both spouses' life. Okay, because with the other one, the catch is you'll get guaranteed income for life if it's a single payout. But if you're married and you died like in 20 years and there's no more account balance, your spouse gets nothing. Okay, they get no refund, and the income, it was a single life. Therefore, it does not go for their life. So I always tell people, if you're married and you're close to the same age, get a joint payout, okay? Because you can see here, you can get $52,000 a year guaranteed from Nationwide, and that's the best joint payout. And that comes for the rest of your life. I mean, you can see the rest of your life and your spouse's life. So in this case, the balance lasts to around 78 years old, but the income is there for life. You can take it out like $1.5 million by the time you're 95. So anyways, but again, the catch is, look at the rider charges, right? They're there, but we already know we don't have to pay them. But if we don't pay them, we just get less income and the account balance lasts longer. That's really the only reason to do it. Okay. All right. Let's look at another catch. Okay. Let's go down here. Look at this surrender charge schedule. Okay. If you decide to surrender the contract, or you take out more than the 10% free withdrawals, they do allow that as well, most of them. Then they're gonna assess a surrender charge. Let's say you were like, you know what, I throw up my hands, I can't, I don't want this anymore. Okay, I just want to cancel it. Okay, you can do that, but let's say you wait like 5 years and you cancel it, they're gonna charge you 6% of the account value to take it out. Is that a catch? Yeah, that's a drawback, right? So you go up here and say, well, dang it, that's not great. I don't like that, John. Yeah, I don't blame you. I mean, you look here and you see, all right, so I got $528,000 in here, and I'm like, I just want to cancel this. I know I can take $52,000 out a year for the rest of my life and my spouse's life, but I still want to cancel it. Okay. Then you can see, look at the cash surrender value, $494,000. That's the catch. Okay. Yeah, you cancel it, you're going to lose a little bit of your principal, right? But I think you lose a lot more than that. If you were to cancel at that point, you're also going to lose the benefit base of $875,000. Okay. And that is what they're using to multiply against this almost 6% rate to give you $52,000. So you just have to keep that in mind when you think about canceling contracts. Another catch is they just don't earn as much as the stock market. Even like an S&P 500 index that you can tie these to, they'll only give you a part of it, like 60%. Which is not bad if you're trying to protect your money, but you have to realize that they are trying to protect themselves. They're buying call options, and they are exercising those call options when they can. Sometimes they cannot exercise those. So can you imagine spending $1 billion on call options and then not being able to exercise that? That's what happens. And so because of that, when they do exercise them, they have to make a profit. Therefore, they limit the amount that you can have. So most of these, at least with the growth ones, I'll say get a fixed index annuity with a cap of like 10 or 11 or 12% if you can get it. Or my favorite is the participation rate, and if you can get it at 60%, and you can get it with a company that keeps it the same or has a reputation of keeping it the same year after year, then that's the best way to do it. And you can average some really good returns for those, and you protect your money against market risk. And yes, they still have a catch. They don't earn as much as the stock market. They have surrender charges if you cancel. Okay. And they have a fee if you decide to buy like a bonus product. Like there's some products that'll give you 20% premium bonus, or you might have a higher participation rate in an index. But in my opinion, when you buy those growth products, you don't need to pay a fee unless it has a purpose. Okay. If it has a purpose and it's going to benefit you monetarily, then great. If not, don't do it. Okay. And I'll share my opinion. Like when you book a call with me, I'll tell you, hey, this will work great, or hey, no, don't do that. So anyways, hope this helps. If you want to purchase an annuity, make sure you go to my website first, look at the annuities that are available. And if it's something that you feel that will fit in your portfolio for your retirement, then book a call with me there. Okay. Otherwise, you can book a call with me right below this video, and it'll go directly to my calendar, and we can get on a Zoom call. And I'd love to help you purchase an annuity if that is what you're looking for. I'm not going to try to hard sell you anything, but I would like to help you if that's what you're looking for. So that's totally up to you. But anyways, I hope this video has been helpful. I hope you are getting some value from this. If you go to my channel, you'll notice I have hundreds of videos that cover a broad array of topics in the annuity space. That is what I specialize in. And there is a lot to know. Okay. I could manage money if I wanted to, but I don't. I don't because I deal with thousands of annuity products. Okay. I deal with over 70 carriers. There's so many things to know in this space. I wouldn't be able to serve people right if I try to do everything. And that's why you have a lot of times advisors that will say, well, I recommend this annuity or these, these two, right? Because they only have access to a couple, or they only really understand a couple because their focus is money management, which is fine. But when it comes to annuities, I would recommend working with a financial fiduciary like myself, someone who is unbiased, someone who will show you everything, someone who has full transparency, and that won't limit you to one or two choices. That's really important if you're looking for the best annuity payout for yourself and you don't want to feel like you're being pushed into something that's paying that advisor a high commission, but maybe not paying you as much. So anyways, appreciate you watching. I hope this has brought you a lot of value. If it has, like, subscribe, share, and if you got questions, make sure you comment below. So thanks again for watching. We'll see you next time.